Hi, my name's David Schulhof. I'm the founder and CEO of MUSQ. We are the first pure play music ETF, giving investors total exposure to the music industry. We trade under the ticker MUSQ on NYSE. I've been investing in the music business for over 30 years. I've run a lot of public and a lot of private companies. I was recently the president of publishing at a public company called LiveOne, which owns Slacker Radio and Podcast One. I was the president at 2 film studios, and prior to that, I was the founder and CEO of a very large private equity-backed company called Evergreen, which owned all the rights from Bill Monroe to Death Row. Taylor Swift was our writer when she was 15. We had Seals and Cross, Roy Orbison. We had 100,000 copyrights in the catalog. I sold that to KKR. That company today is BMG Rights Management. About 2 years ago, I was going to do another publishing company. And I looked around and I saw that there was a lot of competition from Blackstone, KKR, Apollo, Providence Equity Partners. They were all backing management teams that were acquiring publishing companies, and things got really expensive. Springsteen, Bob Dylan, Tom Petty, everything was trading at 20 to 30x. And I realized there were a lot of public music companies out there, but there really wasn't a convenient way to invest in all of them. And so that was sort of the genesis to creating a ETF that now trades and gives investors an opportunity to invest globally in the music industry. The evolution of music is fascinating. Everybody here is probably familiar with music in some way. It plays in your home, it plays in your car. I like this chart because it really tracks the evolution from when Thomas Edison invented the phonograph over 150 years ago. It's obviously gone through massive technological transformation from vinyl to LP records to CDs, to Napster, to Kazaa, and then the launch of paid streaming services around Spotify and Apple and iTunes. And obviously today you have AI. The market for music is massive. So today it's about $103 billion. If you read the Goldman Sachs report, the industry is doubling to $200 billion by 2030. It's really run across 3 different segments: live music, publishing, and recorded music. JP Morgan calls music the most under-monetized media asset. It's the best content story in the history of media. Music today is very cheap. It's half, really, of what you pay for. When you look at streaming services like Spotify, it's half of what you pay for Netflix, for HBO Go. So music is really cheap. At $11.99 a month, you're getting access to 200 million songs. That is a very good value proposition, and that's why you see companies like Spotify raise rates every quarter. That's why that company is up over 150% for the last 12 months and is performing extremely well. This is an interesting chart. It shows you kind of what happened to music. We reached a peak in 2000 of around $20 billion, and it obviously declined in 2000, in 2012 when Napster hit 20 years ago, and then now it's actually grown quite considerably with the growth of streaming businesses. The industry is growing at around 10 to 15% in the US. It's growing as high as 25 to 30% in some of the emerging markets. Top markets today are obviously USA, Japan, UK, Germany, China. We have all these companies in our fund that are driving all of the innovation around music. About half the equities are international, about half the equities are domestic. This is an interesting chart that shows you, as a percentage of smartphone penetration, it's a lot higher in the USA. It's closer to 60%, which is basically saying anybody who has a cell phone has some kind of music service, but it's a lot lower in a lot of the developed markets or in some of the emerging markets. And so there's a big opportunity. That's why music is growing as high as 25 to 50% in the emerging markets, because there's only 15 or 20% that have some smartphone. And so companies like Spotify are now onboarding music in all of these emerging markets. Music around 25 years ago was around 10% of all of the revenue spend as a percentage of the entertainment spend in a household was attributable to music. Today, if you can believe it, it's less than 1%. Less than 1% of what you pay for entertainment comes from music. That shows you how under-monetized music is today and why it represents such a compelling investment opportunity. Consumers were used to spending hundreds and maybe $1,000 a year between CDs and merch and now you're spending $120 to get access to 250 million songs. This shows you kind of the global leaders across streaming, from Spotify to Tencent Music to Apple, Amazon, YouTube, NetEase. I like showing this chart because this is really kind of what our business is. And so if you want to understand the music business, you have to understand that we are in the business of owning copyrights. We acquire songs and we acquire recordings. If you take a classic song like Knocking on Heaven's Door, which was of course written by Bob Dylan in 1973, there was his recording of Knocking on Heaven's Door, and Axl Rose obviously had his version, and you have tons of other artists. So you have many different recordings of them. The recordings are what record companies own. The melody and the lyrics are what publishing companies own. And so when you think about what Spotify does, they're in the exploitation business of copyrights and recordings. Companies like Universal Music Group and Warner Music Group, they are in the business of owning recorded music and compositions. When I had my company Evergreen, we had 100,000 songs. We were in the publishing business. So we had copyrights and we collected royalties every time those recordings got performed, either on radio or were used in movies or were used in advertising or were used in video games. Live music is a massive part of the global music industry today. It's hard to ignore live music. You think back in the last 2 years, you had the success of the Eras Tour. This year, every artist performed, with the exception of Taylor Swift. You had Beyoncé, who had her Cowboy Carter tour. You had Kendrick Lamar. You, of course, had Coldplay. Everybody saw what happened this summer with Coldplay. And then you have venues like the Sphere in Las Vegas, and you had artists like Kenny Chesney and Zac Brown. Revenues are up 10 times from COVID. Tickets have exploded, and Gen Z especially enjoy going out, and they see multiple concerts. We have all these companies in our fund that are exploiting, artists, and everything from Live Nation to Sphere to Madison Square Garden. We have all the ticketing companies like Vivid Seats. These stocks have all performed very well. Live Nation is one of our top holdings today. So Universal Music Group is also another top holding. Taylor Swift is signed to Republic Records. Universal owns Republic. Super fans are delivering massive revenues to all these record companies today. So you have the growth of streaming, but in addition to that, you have super fans that are paying tons just to get access to the artist. Taylor Swift obviously came out with Diary of a Showgirl. I don't know if you saw, she broke Adele's record with the most number of albums sold in 1 week. She had 32 different versions of that album when she sold it. Some albums had like notes in it, other albums had like jewelry in it. The consumers are paying more than 3x to get access to these artists. So this shows you some of the tours. This was from last year. This summer was a massive summer as well. So what is our product overview? So we believe that music is an indispensable item that you have to have in your portfolio, like food, like water. It's really too big to ignore. It's also a very uncorrelated asset class. It's not impacted by tariffs. It's growing 10 to 15% in the US, 25 to 50% in the emerging markets. The ETF has approximately, it's a little less today, it's around 40. We are across streaming and content and live music events and ticketing and equipment and technology. Half the holdings are outside of the US and half are in the US. These are some of the components in the fund. So what is the index methodology? How do we determine what companies go into this ETF? So first, if you look at MUSQ, 80% are pure play companies and 20% of the companies are non-pure play. Pure play meaning the companies generate more than 50% of their revenues from music. Diversified or non-pure play, they generate more than 20% of their revenues from music, and it has to be listed as an independent item on their balance sheet. So, pure play companies are obviously Spotify, Live Nation, Tencent Music. Diversified companies are Apple, Amazon, and Google. So we scrape the universe for pure play companies and diversified companies. All the companies have to have a minimum market cap of $100 million with average daily trading liquidity of $500,000 a day. No single company can have a weight in the fund of greater than 12% and a minimum position size of 25 bips. Emerging markets are capped at 20%. This fund gets rebalanced quarterly on the third Thursday of every quarter. So if one of the names happens to have a stellar performance for that quarter and it jumps above 12%, it'll get crammed back down. And every quarter, there are small companies that grow, they become eligible for inclusion in the fund, and other companies, we also have a negative momentum score. If they perform terribly, they can also exit the fund, or if they drop below the market cap. So this fund creates a very nice cross-section of small cap, mid cap, and large cap companies. It gives investors exposure to big names, like the ones I mentioned, and also smaller names that you may not be familiar with. It gives investors exposure to a lot of international companies in Taiwan, in China, across Western Europe. People know Spotify and Universal Music Group, but you don't know like HIM in Taiwan, and companies in China, and all the South Korean companies. I think we have 8 or 10 K-pop stocks, and you need to own K-pop companies because they are such a huge part of the global music industry. Well, this was a snapshot from a few months ago to give you, a cross-section on all of these different companies. We have a lot of companies, in equipment and technology, in addition to content and streaming and live music. Yamaha, obviously, they produce all the pianos and the keyboards. Dolby and Roland, they are producing a lot of the tools that artists are using and producers to create and rip files, and it's driving a lot of the AI and music production. These are some of our top holdings from a couple months ago. 37% of the fund is roughly content and distribution, so those are all the big record companies, big music publishing companies, a lot of the K-pop companies. 37% is streaming, so that's Spotify and big streaming companies in South Korea. 28% is content, those are the record companies, and 25% are all the live music events and ticketing companies, and the balance are all of the equipment and technology companies. 40% is coming from the US, but we're giving you exposure to companies around the world, and we're buying them and trading them in local currencies. These aren't ADRs, and so this makes it easier for an investor to get exposure. If you wanted to go invest yourself in the global music industry, you'd have to invest, you'd have to do your diligence on all these different companies. You'd have to set up accounts in these different territories and trade them. We make it really easy and convenient for you to invest in the whole industry. And that was me ringing the bell. The fund is doing really well. It's up, I think, 24, 25% for the year. We've been outperforming the S&P and the triple Qs for a while now. We are a very uncorrelated fund. Our fund is really in line with the Goldman Sachs report, which shows that the industry is doubling. Music is just growing so much. Paid streaming subscribers are doubling between now and 2030. I think we're at 800 million paid streaming subscribers worldwide across all the different services. That's going to 1.6 billion. And then you have all these services that are raising rates, again, because music's really cheap and undervalued. So when Spotify raises rates by 10%, by $1, that's very little attrition. People aren't turning off, but that's meaningful because they have 300 million paid streaming subscribers. So when you raise it $1, that's like $3.6 billion of incremental revenue to that service. And then 70% of all of the revenues get paid to the labels as total content costs. And so the labels and the streaming companies, they're kind of symbionts. They work together. When streaming services grow and perform well, the labels perform well. So I think we're really entering into a golden age with music. You have all these massive shows. These artists and billions of dollars are being invested into new venues like Sphere. If you haven't been to Sphere in the last 12 months alone, there was the Eagles and John Mayer and Dead & Co. and Zach Brown. So it's just an exciting time to be invested in music. This is a great way to play the music industry, to invest in the music industry globally, and we're encouraging investors to add this to their portfolios. Thank you.